Welcome back. Uchenna Minnis is the managing partner at Howard Minnis Asset Management Limited. He joins me right now virtually. Hello, Uchenna. Welcome to the program.
Hello, Nancy. Thank you for having me.
Let's get started. What were the sweeteners for the market last week that we saw that gain last week? What were the drivers of that gain? At least I'm talking about equities now.
Right. I think what we're getting to see is some sort of materialization in terms of investor sentiment and the optimism that's coming into the Nigerian economy. You earlier mentioned the Airtel sort of investment or divestment, as you call it. It's also giving some confidence in terms of capital inflow. And there's also the budget proposal talk, really, at the 16 trillion. It's also some sort of positivity when it comes to sentiment. That's what we're getting to see. And generally speaking, due to diaspora Nigerians looking to come into towards the festivity towards the end of the year, there is some sort of comfort on that basis that we get some capital inflow into the spaces, and that in itself would have that ripple effect in terms of putting less pressure when it comes to the naira exchange rate against the euro dollar. So it's like a plethora of effects just occurring at once, although it's not tangible yet. But you know how investors get to act, they get to confront this risk, and they don't act when it happens, they act before it happens. So that's the whole idea. That's what I think we're getting to see towards the end of this year, Nancy.
So should we take that uh, should we really take this that the market has started on a positive note, at least the first trading week of the first week of the last quarter of the year? Should this be the kind of trend we will see towards from now till the end of the year? Or we're expecting that perhaps something will break it in between?
No, I think if the status quo is maintained, we don't get any global shock or local shock, as it were. I think we would get to see this mild bullishness start to pick up steam, and I think that's what we'll get to see towards the end of the year, given the plethora of factors highly earlier mentioned. I think there's that level of positivity now amongst investors or market participants as regards to the market, and that's what we're getting to see with this bullish momentum we're experiencing in the equities market now.
With this, should we suffice to say that perhaps investors are bringing cash to the market now, because we know that we have a high inflationary environment. If you compare also to what is happening in the United States now, inflation has picked up, and Americans and even some other countries are also complaining. We do know that perhaps cash is a very poor form of investment, especially if you take a look at the Nigerian space right now. Holding cash, because you may hold cash today, tomorrow is not as the same value. So cash is a poor form of investment right now. If I'm holding cash, how do I protect myself?
Now, I may need to disagree with you there when it comes to that inflationary pressure angle, and I will explain. The base effect from the pandemic year in 2020 has some sort of caused some this heightened inflationary pressure right now, as you've seen. So, in a way, you cannot exactly argue that this is a significant play as it is. It's just a base effect compared to a very, should I say, not so business activity or little business activity and economic activity during the pandemic. So that base effect is in question. When we start to now argue and say, okay, now we are having an inflationary pressure, as it were, and that's what you see some of the central bankers have come to put out, that this is just transitory and it's not exactly is here to stay, and that's what we're getting to see. So in a way, I could say investors are looking past the inflationary pressure and looking at the base effect from the pandemic year into this year and saying, well, we are not thinking this is here to stay. When we get to see 2022, then we'll be sure, or we'll be more certain that this is what exactly is going on. But in terms of inflationary pressure right now, investors are pushing it on the side. I mean, investors are looking to jump into undervalued and underowned assets, and you have that a lot in the emerging market space. And they know the yield potential is significantly higher when it comes to the developed market, and that's what we are getting to see. And as I said before, if we don't get any shock in terms of global risk or any headwind risk, I think we'll get that bullish sentiment continue to pick up steam into the new year.
Okay, Uchenna, let me put it this way. Inflation in Nigeria is at 17%, just a little over 17%, at least the last data by the NBS. You know that definitely that inflation eats into the pockets and really, erodes the value of the naira. So what kind of diversified portfolio should an investor have right now to be able to hedge against inflation? Inflation in Nigeria hasn't really been temporal because we've seen inflation, at least in the last 2 or 3 years, it's been like this. There was a time we had a kind of reprieve, it came up again. So we've had high inflationary environment for the past 3 years or so. So what kind of diversified portfolio can I build to be able to hedge against inflation, since somehow our inflation seems to be a bit permanent, not too temporal?
So when I was answering your question, was coming from a foreign portfolio investors angle, right? So when we come back to the country, yes, our inflationary pressure has actually been quite consistent and it has been edging higher. Well, as it is right now, we know that what people will get to do is try to hold their investment in USD, really, and in that case, if we have a portfolio mix of about 60 to 40%, in terms of having 60% in USD holding, or any developed market currency, euro or the British pounds, that can really help your case. And also, when you're looking to play within the local investment vehicles, you really need to play safely. Really, in the equity space, yes, it's quite should I say safer, but the fact is it's still the equities market. The risk is still higher there, right, when you're dealing in that space. But the fixed income security space, it's quite safe for us, given the fact that we are in the place where, given we continue to see oil prices at that level, and since we're still a significant producer, still gives us that backbone in terms of security, in terms of government-backed security, like our fixed income space. The Omo play too is a place where investors can look to play, if they really want to have to play around with the pathway using foreign investment as a portfolio investment as a place. So it is more of a mix of trying to have your naira, reduce your naira really, in terms of your exposure in naira, by having a mixture of both foreign currency and a bit of our fixed income space in terms of your portfolio allocation dynamics.
Okay, let's go to the budget proposal, the 2022 budget proposal that the president announced last Thursday. Is there anything for the markets to take away from there? We saw Zainab Ahmed, the Minister of Finance, the next day breaking down those details. Did the market take anything away from that announcement? Or will the market this week be looking at perhaps some of the nitty-gritty of what was announced?
Yeah, I think it sort of it gave some sort of bolstering effect, without any doubt. And this week would now provide clarity as to what the breakdown of this spending would be. And again, this is quite key, because now investors will be really looking at this breakdown to understand, in terms of how progressive and how should I say, how effective and efficient this spending would be, really, and that can help in terms of making plans into the coming year, from a market and investor perspective. And I think it's going to be key when we start to see the breakdown going into this week, Nancy.
The president did say that borrowing, in his speech, he talked a lot about borrowing. Borrowing by this government did also make us come out of recession, and we can't really do without borrowing now, because to the government, that seems to be the best option right now. Do you think that the capital market, especially the equities market, or the capital market, has a role to play, perhaps as we go into 2022?
Yeah, I think as you've rightly mentioned, coming from a pandemic, to not borrow, it would seem like a far fetched situation. It's even developed markets are looking to borrow to, but it's not the borrowing that's the question. It's the implementation of what has been borrowed. That's where the indiscipline comes in terms of a country like Nigeria. And that's where our key problem has been. Borrowing, everybody borrows. to put it lightly. But now when you borrow, you have to understand that, well, this has to go directly into productivity so that you can not only kickstart some sort of bullish economic cycle, you're also looking to set up a viability whereby even when you're looking to service this debt, you are in a very healthy place. And it's a win-win situation. So that's where the trick has always come in for us as a country. It's the indiscipline of how we implement these borrowed monies.
Are there some market stories that you and your colleagues are expecting this week in the marketplace? Is there any, perhaps I don't know, that you want to talk about or that will really influence the market? If yes, can I have those? Can I have that information? If no, perhaps, let's take a look at this month of October, isn't it? The DMO, there was a savings bond that ended last Friday. Eurobond is being expected, a lot of borrowing, the DMO has said. What's your outlook about perhaps the Eurobond market, the bond market space, as well as the money market as we start this new week?
Well, so for us, we've really tried to start to pay attention into the global space because we believe that there might be some exogenous risk that might look to materialize in any moment from now. With what we're looking to see in the global equity space and the fact that it's quite evident that a number of top, should I say, corporations are already over leveraged with debt, and we believe that there might be that contagion risk that might be looking to spread into markets, right? And with the Federal Reserve looking to kick off tapering in itself, that is bullish for the US dollar. I mean, and if you look at the trend for the past 2 years, the dollar has been quite bearish. And technically speaking, in accordance or corroborating with what the Federal Reserve is looking to do with tapering, that might be a big bullish move on the USD. And when we get the USD to start to trade higher, compared to emerging market and frontier markets are going to be on the short end of that stick. And if we get that to start happening, all of this that we've been talking about our country, our currency at the moment, has just been on the situation whereby the US dollar has been trading lower for the period. Now, a bullish US dollar would be quite problematic in terms of our debt exposure and whatnot. So that is quite something we're looking at. We're paying attention to the exogenous risk and also positioning towards that. I mean, in terms of our bond market and our fixed income market space, yes, we just issued those Euro bond, which was quite oversubscribed. So it just highlights, and if you look at the trend for the automobiles and the prime PMA, the primary auctions, you get to realize that there is really key appetite or significant appetite, a material appetite when it comes to our fixed income space. And I think that in itself is highlighting the confidence that both local and foreign investors still have with the country. And we just need to continue to maintain such momentum, really. So I think that is basically the combination of factors we're looking in and how we're looking to allocate our portfolio going towards the end of the year and into 2022. Thank you.
Do you think that the NGX broad index or the NGX indices, the whole of the indices, both the banking and all of that, do you think it really reflects the Nigerian economy, really? Do you think it reflects it? And number two, is it really attached to the economy? Because if you take a look at the Nigerian economy now, we're seeing that a lot of MSMEs provide jobs and provide employment. Many of those MSMEs are not even listed on the NGX. The Minister of Finance also did say that close to 65% of its non-oil revenue comes from the non-oil sector now. So are you seeing a correlation, or there's no correlation at all?
No, it's quite difficult to answer that, really, in an objective way. Let me put it that way. The truth of the matter is, if you even take a robust developed market, for example, their equities space, the US, for example, it's not a direct reflection of their economy, really. And that's what you found out that some lawmakers have tried to highlight, as to say that, well, this is just putting more money in top corporations and not necessarily reflective as to the smaller guys, the medium-sized guys, the small-sized guys, corporations that literally drive employment and also a make good account for labor in the economy. So the truth of the matter is, and if you see it, you will start to break this down, you realize that there is a huge discrepancy. One of the arguments they've highlighted is that the top corporations can easily just get money and just buy their shares back, creating this facade that there is growth, whereas they're just pumping their shares higher. Really. And we don't have a robust or that liquid market here in the country, but I cannot categorically say that cannot be a thing that is happening here. And for us, that is just trying to, that's just being honest to answer your question. It's not a direct reflection, really, and that's my opinion as a team, given the discrepancy as the between the actual drivers of the economic activity and those top corporations that just have the liquidity to be listed in the equities market.
So, Uchenna, what do you think should be done at this time to deepen the market, to perhaps really reflect what's happening, largely speaking, in the economy? I know that many small businesses are not formal, as it were, but what can be done to deepen the market? We've seen a deepening, at least in the last few years. I won't take it away from the regulators and the stakeholders, but what can be done to really, get that link and really deepen the market?
I think this is where the regulators need to step in, sort of make their listing or bottleneck sort of relaxed and flexible. You could have a bit of understanding that some corporations would not meet some liquidity requirements. That's normal, but you could create a system whereby they can match what they can meet in terms of their own capacity and also make it more encompassing between the smaller guys, the medium guys, and the big guys. Then that way you have a broad spectrum of reflection of each of these corporations, and that in a way would give some sort of holistic picture as to what the economic activity is in the country.
Okay, Uchenna, you are there perhaps to manage your clients' wealth, as it were. We are in October, just a few more weeks to the end of the year. So you are there to manage your clients' wealth over a long period of time and perhaps navigate the speed bumps on the way. We've been able to navigate about 9 months. We're in the 10th month now. How do you prepare a portfolio that anticipates storms towards the end of the year and take advantage of upsides if upsides are there?
Well, for us, we're quite flexible in how we adjust and allocate funds in our portfolio, really. And at this point, obviously, there's so much I can say on air, but at this point, we are really focused on capital preservation and reduction in terms of our risk exposure, really. And that's because we believe that there are opportunities for us to take advantage of when the market starts to correct, really. And I'm talking broadly speaking, even from a global perspective. We believe that we can see some stress in the market, and we believe that there are indicators showing that there is something that is looking to pick up. And for us, we need to be able to position ourselves in terms of, as regards to our clients, to take advantage of those positions where we'll be liquid enough when those opportunities arise to themselves. So right now we're playing the cautious play. We are trying not to be too exposed in terms of what we are looking to achieve in terms of yield, but at the same time, we are playing our investment in a very, very cautious in terms of protections in playing with the investment vehicles that are really, really just about providing the bare minimum yield at the same time protecting capital. So we are really more overweighted in the fixed income space at the moment compared to the risky investment vehicles, Nancy.
Okay, finally, as we close, what do you hope to see at the end of this week's trade?
Yeah, I hope to see a continuation of that bullish trend. Maybe another 0.6666770% on the bullish end of the equity space, the ASI. I think that would give or will be in constant play to say that, okay, the investors are quite confident with what they are looking to do into the country going into 2022. And that in itself would also help it to create that ripple effect whereby more FPIs and FTIs who would look to come into the country, and that in itself would help the pressure in terms of our naira to our USD play. And I think the central bank would really, really want that at the moment.
Thank you, Uchenna, for your insights today. Thank you. Have a great week.
Thank you. Thank you, Nancy. Thank you for having me.
Okay, I've been speaking with Uchenna Minnis, who is the managing partner at Howard Minnis Asset Management Limited. We've been looking at the market and some other issues attached to it. Let's quickly take a break to bring in my next guest, Uchenna Minnis, who is a member Joint Planning Committee at the Nigerian Economy Summit. You want to hear more about the summit coming up? We'll be right back after this break. Do join us again.